Welcome back to the Falcon's Nest. I'm your host, Connor Graham, Head of Financial Advisory Services at Graham Wealth Management. Today's topic is how to confidently retire into a recession. Sequential risk is one of the biggest risks to a new retiree. It is the risk that a retiree will experience a series of negative returns early in their retirement, which can deplete their savings and make it difficult to maintain their desired lifestyle. This risk is particularly acute for retirees who are drawing down their retirement savings at a fixed rate, as they'll be forced to sell their investments at a loss if the market declines. This is why it is imperative to plan and protect against this serious risk. For example, let's say a retiree has a 60% equity and 40% bond allocation at the time of retirement. If the market experiences a negative return in the first year of retirement, the retiree will be forced to sell some of their bonds to generate income. This will reduce their bond allocation and increase their equity allocation. If the market then experiences another negative return in the second year of retirement, the retiree will be forced to sell even more bonds. This can lead to a vicious cycle where the retiree is forced to sell more and more of their bonds to generate income, which further increases their equity allocation and reduces the amount of assets that they have to help recover and generate the needed retirement income. This is the danger of sequential risk. The strategy to protect against sequential risk is known as the rising equity glide path strategy. This is a strategy that involves starting with a lower equity exposure early in retirement and increasing the allocation as they get older. This is done in an effort to reduce sequential risk and increase the chances of having enough money to last throughout retirement. There are a few reasons why the rising equity glide path strategy can be effective in reducing sequential risk. First, it helps to smooth out the ups and downs of the market. This is because they have a lower equity exposure and increased fixed income and cash exposure early in retirement. When a retiree has a higher equity allocation in early retirement, they're more likely to experience volatile returns. This can be beneficial in a bull market, but disastrous in a bear market. By utilizing the rising equity approach, it can help protect the retiree from any negative returns that they may experience early in retirement. Second, the rising equity glide path strategy can help increase the chances of having enough money to last through retirement. This is because stocks tend to have higher long-term returns than bonds, and by increasing one's equity allocation as they get older, retirees can increase their chances of having enough money to last through retirement. And even if they experience a series of negative returns early in retirement, they've used this strategy to help reduce the early volatility in their retirement portfolio. The rising equity glide path strategy can help reduce sequential risk and increase the chances of having enough money to last through retirement. If you're concerned about sequential risk, you should speak with a financial advisor to discuss whether a rising equity glide path strategy is right for you. Thank you for tuning into the Falcon's Nest for your financial information. Remember to like, subscribe, comment below, and click the bell icon to get notifications of future uploads. And as always, consult with a financial professional before acting to determine what is best for you.